Hi, welcome all. In this today discussion, we are going to discuss about the statement of cash flow. We all know the statement of cash flow is an important financial statement which show a company's total cash inflow and total cash outflow during a specific period of time. Anyway, we will move to the video we will discuss.
So today we are going to discuss about the cash flow statement. We all know cash flow statement is a statement which show a company's total cash inflow and cash outflow during a specific period of time. Which is a statement which show a company's cash inflow and cash outflow during a specific period of time. So what are the cash transactions included in the cash flow statement? The first thing, sales collection. If we made a sale and we made that collection of that sale, it is a cash transaction. It has to be recorded in the cash flow statement. Paid to suppliers. We have paid to suppliers. Our suppliers, it's a cash transaction. It mean which involved the cash transaction. Investment. We made some investment of equipment or technology. This is a cash transaction. Bank loan. We got a bank loan, which is a cash transaction. Salary or our operating expenses. There are a lot of cash transaction. So wherever the cash transaction involved, there should be an impact in the cash flow statement. So we'll go what is cash flow statement. Cash flow statement provide insight into company's cash inflow and cash outflow, which provide an insight into a company's cash inflow and cash outflow. Mean what is the cash inflow of a company during a specific period. Also what is the cash outflow of a company during a specific period of time. So which showing the statement of cash flow. The statement of cash flow used by many stakeholders like investors, analytics, and others to evaluate the company's performance, which is an important financial statement which show a company's ability to meet its obligation and also its ability to invest in the future by evaluating the excess cash flow in the operating activities. So in the statement of cash flow, the whole business activities are classified into three. The first one is operating activities, the second one is investing activities, and the third one is financing activities. Operating activities are the activities which are related to core business activities or core business operations. Investing activities related to buying and selling of an asset or an investment. Financing activities related to capital structure of the company, whether the raising of new capital or repayment of debt, all these come under the financing activities. So the operating activities include the core business operation that generate revenue and incur expenses, which is the core business activities. For example, if you are a trader, you are a manufacturer, that is your core business activities. All cash inflow related to your core business activity come under the operating activities. Here are the some cash inflow example, that is cash received from the customers, interest, cash dividend received from the investment. All these come under the operating activities. There are some example for cash outflow, that's payment made to suppliers, employees, interest and taxes. All these come under the operating activities cash outflow. And also there will be net income adjustment to net income for non-cash expenses like depreciation, amortization, and also changes in the working capital. This will applied when you are preparing statement of cash flow using indirect method. In the indirect method, to calculate the statement of cash flow from the operating activities, you have to adjust the non-cash expenses like depreciation and amortization or changes in the working capital to see the exact operating cash flow. Here are some examples for operating activities: sales revenue, payment made to suppliers, employee salaries, rent payment, utility payment, interest income, tax payment, refund and return. So all these come under the operating activities. The next activity is investing activities. Investing activities is involved purchasing and selling of long-term asset, investment, property, plant and equipment, securities, everything. So this is come under the investing activities, which mean it's related to buying and selling of an investment or assets. The cash inflow example related to investing activities are cash sale from the property, plant, equipment or investment, or made of sale of the investment. It is which is the cash inflow from the investing activities. At the same time, the cash outflow mean the payment made to purchasing equipment, property, investment. All these come under the cash outflow, which means we have to pay cash to purchase this equipment. So that's why it's coming under the cash outflow from the investing activities. Here are some example for investing activities. The first one is purchase of property, plant and equipment, sale of property, plant and equipment, purchase of investment, sale of investment, loan made to others, repayment of loan made to others, purchase of intangible assets, sales of intangible assets. So which is coming under the investing activities. When you are moving to financing activities involve transaction related to obtaining or repaying capital such as issuing debt or equity, which involve all the activities which related to obtaining and repaying capital such as debt, equity, paying dividend. All these come under the financing activities. In the financing activities, cash inflow involves cash received from issuing stock, borrowing fund, or raising capital from investors. All these come under the cash inflow. That means all these are cash inflow to company. Cash outflow in payment made for repurchasing of stock, repayment of loan, or paying of dividend to state shareholders. All these come under the cash outflow from financing activity. Here are some examples for financing activities. First one, issuance of stock, repurchase of stock, borrowing fund, repayment of loan or debt, issuance of bond, payment of dividend to shareholders, raising capital from investors, payment of debt interest. So here we discussed actually the three activities involved in the cash flow statement. The first one is operating activities, second one is investing activities, and the third one is financing activities. So now we are going to discuss the methods of preparing statement of cash flow. The statement of cash flow, we have two methods to prepare. Actually, it is direct method and indirect method. In the direct method, which report cash inflow and cash outflow directly, providing a clear view of cash activities. In the direct method, which record all the cash transaction directly as a separate line, so which can provide a clear view of all cash activities in the business. But it's in the indirect method, it is start from the adjustment with net income. It is start with net income and adjust non-cash items and changes in the working capital. The indirect method, which directly take the net income and which adjust the non-cash items like depreciation, amortization, all these non-cash expenses are added to net income. Also, which is adjusting the changes in the working capital. Working capital mean in sense of the changes in the account payable, changes in the account receivable. All these are adjusting to net income. So this is the indirect method of preparing statement of cash flow. So here is an example for direct method cash flow. Here the cash received from the customers is 100,000, which mean in indirect method which showing all the cash received and cash payment directly in the cash flow statement. So the cash payment made to suppliers, cash payment to employees, cash payment for operating activities, cash paid for interest, cash paid for taxes. So here this is only the cash inflow, that 100,000. So from this 100,000 we have to reduce all these outflows. So then you will get the net cash from operating activities, which is 17,000. So that means this is the direct method of preparing statement of cash flow, which show all cash inflow and cash outflow directly in the statement of cash flow. So when we go into the indirect method, you see the indirect method is starting with the net income. That means which take net income directly from the profit and loss account and made adjustment for non-cash expenses like depreciation, loss on sale of equipment. These two will show as an expense in the income statement, but there is no cash transaction involved in these two transactions. That means depreciation or loss on sale of equipment. There is no cash outflow. So that means which you are adding back into the net income. And now we'll come to the changes in the working capital. That means there is an increase in account receivable. There is an increase in account receivable, which means the sale we've made which is not collected. That means there is a negative cash impact in the statement of cash flow. That means which we have to deduct it from the net income. And also increase in account payable. there is an increase in account payable, which means the purchase we had made which is not paid. That means there is a positive impact in the statement of cash flow. So which we have to add with the net income. So here is the net cash from operating activities. We start with the net income plus depreciation we have to add plus loss on sale of equipment we have to add. And we have to reduce increase in the account receivable. And we have to add increase in account payable. So in this case, the net cash flow from the operating activities is 56,000. So here we will go through an example for preparing statement of cash flow. Here is a case study where the net income is 50,000. So cash at the beginning is 10,000. Cash at the end of the year is 15,000. Depreciation expense is 5,000. Account receivable increased by 3,000. Account payable increased by 2,000. Purchase of equipment for cash is 8,000. Loan received cash 6,000. So we are going to prepare the cash statement of cash flow through indirect method. So we'll start with the net income. Obviously, we have to add depreciation with the net income. And also there are two more transactions. Account receivable increased by. If there is account receivable increased, we have to deduct from the net income because that means it is a negative cash impact. Also, the account payable increased by, we have to add with the net income because it is a positive cash flow impact. So in this case, the net cash flow from the operating activities is net income plus depreciation minus account receivable increase plus account payable increase. So which is 54,000. Which means this is cash flow from operating activities in this case. When we are evaluating the investing activities, in the investing activities, there is only one activity is there, that is mean purchase of equipment for 8,000. So in the investing activities, we have one more activity, only one activities, which is purchase of equipment, 8,000. That means which is a cash outflow. So the investing activities cash flow is minus 8,000. The other activity we notified that it is financing activities. The financing activities, we have only one transaction, that is loan received 6,000. So in this case, there is only one transaction in the financing activities, which is loan received, that is 6,000. So the financing cash flow is a positive cash flow, that is 6,000. So in this case, the summary of statement of cash flow is operating activities is 54,000, which is positive. Investing activities 8,000, which is negative. Financing activities 6,000, which is positive. So the net increase in cash is 52,000. That means 54,000 minus 8,000 plus 6,000. So cash at the beginning of the year in this case is 10,000. So the cash at the end of the year should be 62,000, which means 52 plus 10,000. So this should be the cash at the end of the year. So here we discuss how we have to treat changes in account receivable and account payable in the statement of cash flow. So here is the details. If there is an increase in account receivable mean the sales we made which are not collected. That means the cash not collected. So when we are preparing cash flow statement through indirect method, we have to deduct or subtract these changes in increase in account receivable from the net income to calculate the operating cash flow. In the same time, if there is a decrease in account receivable, which means we have collected previously made sale, we have collected. So that means there is a positive impact in the statement of cash flow, in the operating cash flow. So that we have to add to the net income to calculate the operating cash flow. At the same time, there is an increase in account payable. That means the purchase we made which will not paid. That means there is a positive impact in the statement of cash flow. That means which we have to add to operating cash flow. At the same time, if there is a decrease in account payable means the previously purchased transactions are paid now. That means there is a negative or impact in the statement of cash flow. That means which we have to deduct or subtract from the operating cash flow. So here is the summary of statement of cash flow what we discussed today. So first one, the purpose of statement of cash flow is to show cash inflow and cash outflow, indicating a company's liquidity and financial health. The statement of cash flow which show a company's cash inflow and cash outflow during a specific period of time, which indicate a company's liquidity and financial health to evaluate for different stakeholders. This is the first one we discussed. There are three activities or three sections in the statement of cash flow when we are preparing. The first one is operating activities. Operating activities, which we discussed already, the cash inflow and cash outflow from core business activities, which is operating cash flow. The investing activities investing activities are the activities which related to buying and selling of the assets. In this session, it include all the cash inflow and cash outflow which is coming from the buying and selling of asset or investment. The financing activities which related to raising of capital or or transaction related to company's capital structure. That means cash from debt, equity and dividend, or repayment of debt or equity or dividend. All these come under the financing activities. The net cash flow the total changes in the cash over a specific period of time. That means there is a total cash inflow, net cash flow from all these activities, net cash flow from operating activities, net cash flow from investing activities, also the net cash flow from financing activities. So all these the sum of all these is net cash flow. Also, we have discussed that we have two methods to prepare the statement of cash flow. One is direct method and the second one is indirect method. And also the cash flow statement, the focus on the actual cash transaction, cash movement, not the profit. So when we are preparing the cash flow statement through indirect method, we have to adjust the non-cash transactions with the net profit to calculate the cash flow from the operating activities. Also, it is an important financial statement which help different stakeholders to assess the cash generation, debt repayment, and investment potential to make various financial and operational decisions. So, it is an important financial statement which can assess the cash generation ability or how much cash generated in the previous period, and its repayment ability, and also the investment potential. I mean, if there is an excess cash in the business or in the organization, there is a good potential to invest that excess money and to improve the overall business efficiency. So to evaluate all these strategic, financial, and operational decision, the statement of cash flow is an important financial statement. So this is about today's discussion. Thank you for watching this video. All the best.